If you watched our lesson, Why Buy a Call, you know that the buyer of a call option wants the price of the underlying stock to go up. But what about the seller of a call option? What do they want to happen? Well, you can think of the relationship between buyer and seller like the one between a person standing in front of the mirror and their reflection. When that person raises their left hand, it appears as though their mirror double raises their right hand. Just like this, the call seller wants the opposite. They don't want the underlying stock price to rise. Nope, they want it to stay below that strike price. Let's look at an example with our option seller, Sarah. Keep in mind, this example doesn't include commissions and other fees. Ensure you understand your broker's fee schedule before trading options. Sarah sells a call with a $35 strike price when the underlying stock is trading at $30. The option trades at a price of $1 and has a multiplier of 100. She receives a premium of $100 from the buyer, Jack. She's obligated to sell the stock at $35 if the option is assigned to her on or before the expiration date. Sellers are also described as going short the option, meaning she profits from the trade if the price of the call goes down from the dollar value she sold it for, just like shorting a stock. Now let's say that underlying stock rises to $40 before the expiration of the option. That means the contract also climbs in value. It's now worth $500. If the option is exercised and Sarah is assigned, she's obligated to sell the stock at $35 per share. Sarah sold the option for $100 before she ended up having to sell the stock for $3,500. This makes her cost basis, or book value, $3,600, or $36 per share. That's her break-even point. Do you remember the shortcut for calculating the break-even point from the Why Buy a Call lesson? We take the option traded price of $1 and add it to the strike price of $35. When she's assigned, if Sarah has no shares of the underlying stock in her account to begin with, she'll end up being short 100 shares as a result of the transaction. This means she's selling a stock that she doesn't own. To learn more about how the short selling feature works, check out our lesson in the Cash and Margin course. Now it's her turn to make a choice. Sarah can choose to keep the short position for as long as her margin and brokerage firm allows, with the expectation that the stock price will drop lower. That way, she might be able to buy back her shares at a cheaper price and obtain a larger profit. Or she can close her short position by buying back 100 shares of the underlying stock at the market price of $40 per share for a total cost of $4,000. If she decides to close out the position now, she locks in a loss of $400. That's $4,000 to buy 100 shares at the current price, minus the $3,600 cost basis on the 100 shares she's short. Not an ideal result. However, if the option is not assigned to her, she keeps the $100 premium she received when she sold the option. This is her maximum profit. But what is Sarah's risk as a call seller? Well, we know she loses money if the underlying stock rises above her break-even price. And since a stock can go up indefinitely, her maximum loss is unlimited. If this all sounds familiar, it's because it's the mirror image of what our call buyer Jack experiences. Unlimited profit potential if the stock goes up, but a maximum loss limited to the premium he paid. The scenario we just walked through for Sarah is called selling a naked or uncovered call. An approach with less risk when selling calls is when you own the underlying shares. That strategy is known as covered call writing. We'll go over this strategy in a later lesson. So let's recap what we've learned about selling a call. Call sellers want the underlying stock to stay below their strike price. Their break-even point is the premium they receive plus the strike price of the call. Their maximum profit is the premium they receive from selling the call. Their maximum risk is potentially unlimited. Now that you understand why option traders buy and sell calls, you're ready to watch our lessons about buying and selling puts.